think it's really concerning for quarter three or quarter four. I think right now we're in a little bit of an eye of the storm where, like I said, liquidity indicators look okay looking out a couple months, because you kind of have liquidity being taken out and other liquidity being put in. And the question is when you get, towards the later part of this year, when a lot of these things all coincide to kind of be bad for liquidity and bad for growth, I think that's where storm clouds hit.
Over the past few months, the financial markets have been experiencing ups and downs. Recently, the U.S. Federal Reserve has increased interest rates by a quarter point, leading to a mixed response from experts. On one hand, Fed Chairman Jerome Powell confirmed that the savings of all depositors are safe post-banking crisis. But on the other hand, some economists are warning that the U.S. is headed for a slowdown this year as the Fed continues to wage war against inflation. The battle is likely to result in real costs, such as rising unemployment rates. While containing the banking turmoil is important for the markets and the economy, it's only one part of a complex equation. So what will the Fed do next? Some analysts and pundits believe that we are headed towards infinite quantitative easing, while others believe that this is all just a setup for the coming implementation of central bank digital currencies, CBDCs. In an interview with Wealthion, macro analyst Lyn Alden provided her insights on what she thinks is coming next for the Fed and what their options are. Alden believes that we are currently in a waiting game and the next few months will be a crucial time period with storm clouds on the horizon. She also shared her thoughts on where she believes the crypto industry is headed and how the government is not yet technologically ready for the changes that are upon us. Before we get into the video, make sure to leave a like and subscribe to help our small channel grow. Now, let's listen to what Lyn has to say.
I think it's really concerning for quarter three or quarter four. I think right now we're in a little bit of an eye of the storm where, like I said, liquidity indicators look okay looking out a couple months, because you kind of have liquidity being taken out and other liquidity being put in. And the question is when you get, towards the later part of this year, when a lot of these things all coincide to kind of be bad for liquidity and bad for growth, I think that's where storm clouds hit. And how concerned to be partially comes down to how you think people are going to navigate it, right? Because this is an actively managed system, and a lot of it will come down to human decisions. And there's ways to cause a massive liquidity shock, and there's also ways to just kind of like flood it with liquidity, and kind of weaken on the inflation fighting front. And so I think it'll be pretty pivotal decisions by the Fed. I think an instructive period to be familiar with is the repo rate spike of 2019. That was the last time that quantitative tightening ended. The Fed was drawing down their balance sheet in 2018, 2019, and they did so until September 2019 when they caused their repo rate between banks to blow out. And the Fed had to come in and participate in the repo market. But there are a number of us at the time that were pointing out that they were basically, the system was being flooded with T-bills, and the Fed was going to have to start buying some T-bills. And about 3 weeks later, that's what they had to do. And I think we're kind of in a similar environment now, where right now they're still trying to be tight with their actual balance sheet, but then they're offsetting it by loans. And I think they're going to find a time later this year where they're unable to keep doing quantitative tightening. It doesn't mean that they necessarily turn to QE right away. But I do think that at least on one of those liquidity fronts, that quantitative tightening portion, I think that's likely to stop because there's not much else liquidity that can come from the system. And I think that's the thing that I think they overall kind of basically overestimated how much liquidity is in the system. And another factor that's challenging is that the Treasury generally has options. I mean, they could, for example, when they want to refill their Treasury general account, they could issue almost entirely T-bills. They could issue a flood of T-bills, and that would pull liquidity out of the reverse repo market most likely. And so that would actually be the least harmful way for liquidity in order to carry on. But of course, it would shorten the average duration of U.S. Treasury debt. It'd be the least interest rate effective way to do it. So again, it kind of comes down to like choices by Yellen and others of how they want to handle that. And one of the things you've seen recently is that they don't generally respond well to technological changes. And technological changes are things that kind of move slowly, but then they move all at once. And what I mean by that is when you look at the history of fractional reserve banking, it's kind of based on the premise that the settlements are slow and the transactions are fast. And what banks do is they provide that arbitrage in between. So if you go back to say a gold-based free banking system or something like that, the gold itself is slow. But then once you say deposit gold in a bank, you're now part of this like telecommunications connected global ledger that
Mhm.
allows you to move money around quickly. And so there's relatively, few reasons why people want to pull their money out. It's generally like you're pulling it into a slower state when you pull it out of the banking system.
Mhm.
And so they kind of rely on people wanting to have their money in the banking system to benefit from that speed. What we've seen kind of in recent years, recent decades, is that the settlement speeds have especially it's all fiat now, but even in a fiat system, when you add social media, when you add, some of these banks that failed, for example, they had software APIs where they could just tie their money management right into the business's software. So like people could basically pull their money out without really interacting with the bank in question. And the easier it is to deposits to move around, the more it changes liquidity needs for these types of banks, right? You can't cut it with like 5% of deposits covered by liquid cash.
Mhm.
I mean, there's a broader discussion around fractional reserve banking in general, but even among fractional reserve banks, it's like there's different levels of liquidity. It's like, can you take a 5% bank run or can you take a 50% bank run or anywhere in between? What's the number? And basically, as that speed mismatch between settlements and transactions has closed, and as like the settlements can move around super quickly, those liquidity thresholds that are so low don't really cut it anymore. And so the Fed's basically ironically pulling liquidity out of the system in a world where because of technology, they need more liquidity.
Right. Right. All right. Well, that's super interesting. And I guess let's tackle this head on for a second. So we've had a couple recent banking failures, both in the US and in Europe. The banks that failed here in the US largely failed because of what did them in fatally was reasons that were idiosyncratic to those banks, but they were vulnerable for on several fronts. But one big one that a lot of banks are vulnerable from right now, which is the Fed and other central banks brought interest rates down to historically low rates and held them there for a really long time. And so the banking system adapted, right? And it's a borrow short, lend long, type of model. And they optimize that around interest rates being super low and continuing to be super low. And then all of a sudden, the Fed raised interest rates faster than at any point in history. And sort of the analogy I've used is it sort of got everybody used to driving 100 miles an hour in the car, and then it just jammed on the brakes, and now the bodies are slamming into the windshield here, right? So I guess where I'm going with this is you're nodding as I was saying that, but like how big of an issue and how persistent is it going to be in the banking system? In other words, is the banking system going to be able to kind of react to this and we're going to be okay, or is for all these additional tightening elements that you're talking about, are we placing greater and greater stress on the banking system at this point?
So I think there's three different layers here. One is, as you point out, the underlying Fed actions. Basically, it's hard to operate when the Fed is zigzagging all over the place. A lot of people can criticize them for cutting interest rates super low and doing all sorts of QE. But for consistency, I mean, if they jack rates up super quickly and they do quantitative tightening super quickly, it also causes problems. Basically, it's like you're changing rapidly the entire monetary base of the country to try to either in some cases they're trying to have inflation be higher, ironically, other times they're trying to make inflation lower. And the speed and the aggression with which they move around makes it a very difficult environment to operate banks, do long-term contracts, run a business, right? It's a very actively managed system. And I think there's a lot of criticism that can be kind of put at them and say, does it need to move around this quickly? Like, what do you like? The active management that's happening is I think overdone in both to the upside and the downside. They always seem to push it too far, and it's like this doesn't need to be like that. And the next layer up is obviously certain banks handled this environment better than others. Some of them became more addicted to the environment than others. Other ones were more sober-minded and kind of positioned themselves to a potential ending of that environment. And so some of the banks that ran into the most problems are ones that did the most long duration types of securities. The
Right.
challenge is that,
Or didn't hedge like Silicon
yeah,
Valley. Right.
or
Yeah.
that didn't hedge. And a challenge is that everybody's right now focused on the unrealized losses in securities, but there's also unrealized losses in loans. And the loans are less liquid, less transparent.
Yep.
And that's what banks are kind of supposed to do in the current environment. They're supposed to take in deposits and make loans, including 30-year mortgages, including these types of loans. And so they're really kind of supposed to do this duration transformation. And now they're in an environment where they're getting rapidly punished for that duration transformation that their whole premise of existence is to do. And so larger banks, like say JP Morgan, but even just like large super regional banks, they can hedge better. They can have a bunch of short duration securities to offset some of their long duration loans. They have a lot of options available to them, whereas small and medium banks, they have a higher percentage of their assets in those loans. And they just have kind of less just overall tools to deal with those types of liquidity problems. The third layer of it is that, so historically, when the Fed raises rates, you don't see a lot of action from bank deposits. There's generally, rates go up, T-bills go up, but bank deposits stay pretty low. And so that gap widens between deposit rates and, say, T-bill rates. And it's often because it doesn't last very long before the Fed causes a problem and has to cut. And also because people just feel safe in their banks, especially if you're a business and you're actually using your bank for payroll and like money's going in and out. But if you stay in an environment where that gap is larger than normal and it's longer duration than normal, then more deposits want to flow towards those higher yielding and safer things, which forces smaller banks to raise deposit rates in a way that like JP Morgan doesn't have to raise rates because everybody wants an account at JP Morgan. So they can hold rates at like zero, whereas, community banks, regional banks have to raise deposit rates if they want to avoid deposit flight. And then the problem is because they lent at long durations at low rates, even if they don't have a liquidity crisis, they start to have pressures on their profitability.
Right.
And their ability to make new loans, their ability to retain employees. They're more likely to be targets of M&A activity, right? Because if you have multiple small banks that are barely struggling with profitability, they're more likely to merge together or get acquired by a larger competitor. So I think one of the challenges is that this is going to slow certain things down, but it's also going to result in more and more bank consolidation.
Yeah.
Overall, the financial markets are in a state of flux, and the actions of the Federal Reserve will have a significant impact on the future of the economy. It remains to be seen what the Fed will do next, but experts are keeping a close eye on the situation to anticipate any future developments. You can find the full interview in the description section. Let us know what you thought of Lyn's comments. Thanks for watching.